Welcome back to Investing Talk Podcast.
Today we are counting down the top 5 stocks to buy right now, based on our latest research. And this isn't just, reading headlines. Our mission for this discussion is really to pull together all these different financial reports, analyst notes, market chatter, basically everything we've gathered to give you a clear, actionable story behind the numbers.
Yeah, this is a big one. We've really sifted through, dozens of potential plays to find these five unique opportunities that seem to offer pretty interesting risk-reward setups right now. Before we get to our first pick, please do subscribe, like, and comment. It really helps support the show. And definitely, if there's a specific company you want us to look into, just leave it in the comments below.
All right, let's start the countdown then. We're kicking off with a couple focused on, let's say, tech execution and having a real edge. So what's the first name on our list?
Okay, first up is Multisensor AI Holdings. The reason it's really standing out in our research is that it has this incredibly rare mix, aggressive growth combined with really robust margins. That suggests they might have a kind of moat protecting their business. If you look at their fiscal year 2024, they reported a massive 36.32% year-over-year revenue jump. That's pretty clear evidence of, rapidly expanding market demand and that they're executing successfully, especially in tough sectors.
Yeah, that growth rate is definitely impressive, yeah. But what I think is truly compelling here, what's probably driving the valuation, is that margin structure you mentioned. Their gross margins are incredibly high. What was it, 60.7%?
60.7%.
Right. That kind of number is a clear signal of likely proprietary technology, maybe patents or some very specialized know-how, and also just efficient cost management, something their competitors probably find hard to copy easily.
Okay, but what are they actually doing that lets them keep that 60% margin? I mean, why aren't competitors eating into that?
Well, if you look at the markets they serve, industrial, defense, the standards there are incredibly high.
Right.
That's the key, I think. They aren't just selling some commoditized software package. They specialize in integrating sensors and data processing platforms for really critical infrastructure. Think like predictive maintenance for giant industrial machines or sophisticated surveillance systems for defense. Their platform, MSAI Connect, it kind of locks customers in through deep integration. It makes switching out really unlikely once it's deployed. And because what they offer is pretty essential for operational safety and efficiency, they can maintain that premium pricing.
Gotcha. And it seems like the market is buying into that confidence story too, right? Didn't they just raise some significant cash?
Exactly. They recently secured about $14.4 million. It came from what's called a registered direct offering with a prominent institutional investor.
Okay, maybe break that down. A registered direct offering.
Yeah, sure. So for anyone unfamiliar, it's basically selling new shares directly to sophisticated investors, usually big funds. Often it's at a slight discount, and it lets them bypass the, sometimes volatile public market process. It's a pretty clean way to raise capital quickly. And seeing institutional money come in like this, it signals real conviction in the company's future. Plus, this cash is specifically earmarked for speeding up their platform development.
So momentum, great margins, and fresh capital. Sounds like a strong setup.
It does. And looking ahead, their Q3 earnings are expected pretty soon. Analysts are targeting, significant upside potential. Some of those price targets imply gains of well over 100% from where the stock is now. And technically speaking, the stock's been consistently trading above both its 50-day and 200-day moving averages. That kind of confirms this bullish accumulation phase we're seeing. So yeah, it's a story of proprietary tech meeting strong demand in high-value markets.
That makes a lot of sense. Okay, so we've laid out the case for a proprietary tech play. Now let's pivot completely. Let's look at companies where the value is more tied to physical assets and infrastructure. Less about code, more about concrete, or maybe in this next case, land and energy.
Interesting transition. Okay, moving on then. My pick for the next one is New Era Energy and Digital. This one is really all about a strategic transformation. I mean, for a long time, this company was mainly just holding assets in traditional energy. Helium, oil, natural gas.
Right, and because of that history, their trailing revenue has been kind of modest and cyclical too. So what's changed? What's the big news?
The monumental news, the real game changer, is this strategic pivot. They secured a new land option, I think it's in November 2025, for a massive 7-gigawatt AI data center hub.
7 gigawatts?
Yeah, it's an incredible move. It leverages their existing assets in a completely revolutionary way. They already own significant land for resource extraction, but now they're positioning that same land as prime real estate for energy-backed AI infrastructure.
Okay, here's where it gets really interesting for me. That AI data center news, it caused like a 20% stock surge almost instantly, didn't it?
It did?
Marked a strong reversal, a breakout from those multi-month lows. So they already own and operate a lot of land, what is it, over 137,000 acres,
Mhm.
primarily for resource development. But this strategic decision to use that land to support the, well, frankly, unprecedented power demands of AI computing, that's a major differentiator. They aren't just building a data center. They seem to be leveraging their energy footprint to power it. That could mean potentially cleaner, maybe cheaper power than competitors can offer.
Exactly. That's the whole angle. This transformation, it basically re-rates the entire business model. It turns what was a cyclical energy asset holder into an infrastructure play that supports, well, probably the fastest growing sector in the world right now. And we shouldn't overlook the necessary corporate housekeeping they did, too. The stock also recently regained Nasdaq compliance. I think that was back in October 2025.
Oh,
That mitigated a short-term risk that had kind of been plaguing market sentiment, and it limited institutional interest before.
yeah. Getting that compliance issue sorted is absolutely critical for attracting bigger investors, definitely. And the trading volume looks pretty elevated too, what, over 16 million shares a day? That does indicate strong accumulation, likely ahead of their Q3 earnings release, whenever that is. The market's clearly anticipating this pivot, driving revenue much faster than traditional energy ever could.
It really is the definition of legacy assets meeting future tech. Now, the risk here is obviously execution. I mean, a 7-gigawatt data center? That's an immense undertaking. But the potential reward, if they successfully pull off this transition, it's exponential.
Okay, so we've looked at one sort of pure growth tech play and one asset-backed digital pivot. My pick for number 3, Vivacor, keeps us in that infrastructure and energy space. But this one is, well, it's clearly a higher risk, higher reward situation. It focuses on environmental remediation and infrastructure build-out.
The numbers you pointed out certainly support calling it extraordinary.
They are pretty staggering, yeah. The most compelling factor is just that extraordinary top-line growth. They reported a massive 133% year-over-year increase in Q1 2025 revenue, hit $37.3 million, and gross profit also soared an incredible 345%. That suggests, explosive demand for their remediation services, and maybe some efficient operations in their trading segment, too.
Okay, let's unpack the core risk here, though.
For us.
Because yes, that kind of growth is rare, even for a smaller company, but it often comes at a cost. The company is actively raising capital to fuel this really rapid expansion, specifically for their trading operations. Back in October, they secured a $40 million commodity intermediation facility.
Right, let's pause on that term, commodity intermediation facility. What exactly is that, and why does it introduce such high risk?
That's a great question. So this facility, it essentially lets them finance the purchase of physical crude oil before they sell it on to the end buyer. Basically, they borrow against the value of the physical oil they hold or are currently moving. It lets them rapidly increase their scale. They can transact far more volume than they could using just their own balance sheet. But it instantly increases their trading risk. If the price of crude oil suddenly moves against them while they're holding inventory, well, that facility turns into a significant liability fast.
Okay, so using that $40 million facility, doesn't that risk instantly wiping out those amazing gross margins if the oil price swings the wrong way? How is management mitigating that specific trading risk? Are they just hoping prices stay stable?
That's the absolute central question facing investors here. It's execution risk versus market risk, right? We have to assume management is using hedging strategies, but the sustainability of that margin growth, it becomes precarious when you layer on this much leverage. So the upcoming Q3 earnings, I think they're due November 20th, those will be critical. If those results confirm the Q1 trajectory and importantly show they're managing the new debt and trading risks responsibly, then the stock, which is currently trading well below its moving averages, could see a really sharp technical rally as that perceived risk unwinds.
Yeah, it sounds like a pretty binary outcome. Definitely not one for the faint of heart. That volatility makes it a pure bet on management executing well in a, well, rapidly expanding but highly leveraged environment.
Absolutely. Okay, now let's shift back to pure technology again, specifically a turnaround story that seems to have strong contract execution in the rapidly growing digital identity space. Let's talk about BioKey International.
Right, moving to number 4, BioKey International. They focus on identity access management, IAM, and biometric security. And this is a technology turnaround story that our sources suggest has shown a pretty clear and accelerating growth inflection point. Seems like the reversal from their prior contraction is really taking hold.
Yeah, and it's such an essential sector today for anyone listening who might not track this stuff daily. Identity access management, or IAM, it's basically the tech that makes sure only the right authorized users can access specific systems, data, or resources. Think of it like the core security layer for everything from, say, your mobile banking app to federal employee login security. And as global connectivity just explodes, so does the demand for seamless but also secure access.
And the numbers seem to reflect that demand. Their Q2 2025 revenue was up 49% year over year. That's pretty robust acceleration moving into the second half of 2025. And it seems fueled by some major high-stakes deals they completed recently.
Yeah, those deals are critical evidence that they're executing. We saw them complete a major IAM deployment in the Mozambique banking sector. That represents, a successful entry into a new, complex enterprise market for them. They also secured over $600,000 in follow-on orders from a foreign defense ministry.
Follow-on orders. Interesting.
Right. The latter is arguably even more important because it signals not just winning new contracts, but actual customer satisfaction and repeat business in a really sensitive, high-value field like defense.
What's also fascinating here is how institutional investors have kind of shown their confidence, right? That often speaks volumes about perceived long-term viability.
That's exactly right. Institutional investors signaled pretty deep confidence earlier this year by exercising over 3 million warrants at $1.02 per share.
Okay, warrants. Maybe a quick explanation.
Sure. So a warrant gives the holder the right, but not the obligation, to buy shares at a specific price sometime in the future. When sophisticated investors choose to exercise those warrants, like they did here, it means they are voluntarily putting millions of dollars back into the company. That directly boosts its available working capital and really enhances its financial resilience for, future growth investments.
Got it. So it's not just analysts talking bullishly, it's actual money flowing onto the balance sheet. Although analyst sentiment is overwhelmingly bullish too, isn't it? 6 out of 7 rated to buy.
They clearly see these contract successes as the fuel needed for sustained earnings growth ahead. It's definitely a compelling turnaround story where it looks like past operational issues are being overcome by verifiable contract wins and strong institutional backing.
Okay, that brings us to our final selection, number 5, Data Vault AI. This one is arguably the most speculative pick on our list today, but if the right catalysts actually happen, the short-term upside potential could be immense.
Yeah, we really must approach this one with extreme caution because it presents this extraordinary divergence. And our sources definitely highlight some serious financial red flags here. On one hand, the fundamentals show deep negative net income, like a staggering loss of over $68 million in the trailing 12 months.
68 million loss. Oof.
Yeah. And persistent cash burn. Plus, we've seen recent insider selling too. For example, one insider sold, I think, over 130,000 shares not long ago.
Okay, for listeners, why is that combination, massive losses and insider selling, such a material uncertainty? What's the big worry?
Well, it raises what auditors call a going concern risk. Basically, it means the company's ability to continue operating without raising more capital, which would likely dilute existing shareholders or fundamentally slashing its cost structure. That ability is seriously in question. And usually when people inside the company are selling stock, it doesn't exactly scream confidence in an immediate turnaround,
Right. But despite all of that, we have this intense analyst optimism. Technically, the stock is trading above its 200-day moving average, which signals some momentum. And critically, analysts are maintaining a strong buy consensus with a 12-month target that implies, a massive 77% upside from current levels. Why are they so bullish if the financials look so dire?
Okay, so if we try to connect this divergence to the strategic landscape, the optimism isn't based on current operations at all. It seems to be based almost entirely on a single, potentially game-changing event. The upside really hinges on event-driven news. Our sources point to this persistent market chatter, these rumors, about a potential partnership with a major Swiss exchange.
Okay. That would be a huge legitimizing factor if it happened.
It would be monumental, absolutely. So analysts are essentially assigning a high probability to that partnership, or maybe a similar major revenue catalyst actually materializing. If that partnership gets formalized, or maybe if they announce some unexpectedly positive news after their Q4 earnings, then the stock could re-rate very quickly, potentially overwhelming the short sellers and those negative fundamentals. But this is purely for investors who are comfortable with extreme volatility and are essentially betting on the successful execution of speculative binary events rather than, steady linear earnings growth.
Understood. Yeah, pure catalyst trade for sure. So, okay, to recap, our 5 stocks to watch are multi-sensor AI holdings, that's the high-margin tech worth play. Then New Era Energy and Digital, the asset-backed AI infrastructure pivot. Vivicor, the high-leverage, high-growth infrastructure play, but with significant risk. BioKey International, the security turnaround story with that institutional backing. And finally, Datavault AI, the highly speculative, event-driven potential rocket.
That's a solid list, I think. It covers a pretty wide spectrum of risk and growth profiles, doesn't it? From proprietary tech to leveraged infrastructure. As always, please do your own research before making any investment decisions.
Absolutely. And maybe just before we close, here's something to think about. If the most speculative plays right now, like that last one, are being driven by hopes of partnerships with major exchanges or the promise of massive AI data centers, what does that tell you about how quickly Wall Street is pricing in the absolute necessity of AI infrastructure over, say, the next 18 months? Something to mull over. Thanks for tuning in.